So my name is Brian Klinksiek, and I'm the Global Head of Research and Strategy for LaSalle, which is a global real estate investment management firm. I presented 5 themes. The first one was searching for peak rates, so the impact that higher interest rates are having on property pricing. We thought earlier in the year that rates were kind of found a stable range, but later in the year there was this surge, and so we're still dealing with the impact of that. One of the big points that I made is that real estate investors, we spend a lot of time in conferences debating where interest rates are headed, trying to forecast interest rates. But if you really had a high conviction view of where interest rates are headed and you wanted to monetize that, would you really invest in this slower moving, higher transaction cost asset class? So really then tried to shift the focus into where we see value within real estate, because I think that's the pertinent question for the real estate group. So then we moved into the second theme, which was solving the capital stack equation. So higher interest rates have really upturned a lot of capital stacks for real estate deals and debt issues, debt refinancing, and that creates a lot of challenges and a lot of opportunities. And one of the places we see big opportunity today is in being a lender or investing in debt-like positions. The third theme, I shifted to talk about property fundamentals. The third theme is coming off the boils. So the very hot sectors of logistics and residential in terms of rental growth, that is generally moderating today as we kind of work through post-pandemic normalization and also supply that shovels in the ground put it there in 2021 when the economics of development were so positive for development. So we're kind of moving through that as a market today and processing the impact of weaker apartment rental growth, weaker logistics rental growth. But I did point out that those sectors are still very strong relative to other sectors. So they're slowing versus the peak of last year, but still much stronger than most of the rest of the real estate market. My fourth theme was about beyond bifurcation, these divides between quality buildings that we see within sectors. So experiential factors, is it a cool place to be? Is it a commute-worthy experience? Sustainability features, is it a green asset? And so this theme of bifurcation is mentioned a lot in the markets, but it's sometimes used as a kind of excuse for why maybe office is okay, because the best offices are okay. And I really tried to drill into that and say, what does that really mean for investment? It's usually the case that the best quality assets do better than worse assets, but is that an attractive, investable theme? And then I moved on to recommendations, tactical and strategic investment recommendations. And one of my big points there was the shifting definition of what is core real estate, and sort of following that, we're moving from a world of being focused on heuristics and rules of thumb like lease length and credit quality to observed resilience of income, being comfortable with operational intensity if it comes with exposure to secure income streams and growth potential, and being positioned as an investor to benefit from that transition from an old world of those heuristics to sort of a modern view of what constitutes good quality core real estate. I'll make 2 points related to that. The first is that moments of disruption and repricing and challenges, if you look historically, they've tended to be the best vintages to invest in real estate. One of my favorite quotes about investing is, now is always the hardest time to invest. So there's a lot of uncertainty out there, but the history has shown that when there's a lot of uncertainty, it is a good opportunity. What do we see in the near term as attractive? Well, it's sectors and markets that have repriced more readily, more rapidly. So being a lender, debt has reprices dynamically. Listed real estate reprices dynamically. And then participating in some of those emerging sectors and the markets where we see strength in sheds and beds, enough that you can still generate an attractive forward IRR despite the rise in interest rates. So basically, places where there's enough growth. But in general, I think approaching the market as a patient opportunist, being ready to solve problems, that's the biggest opportunity in the next year, because we'll be working through literally workouts in real estate. Take apart your investment thesis and break it down into what you're really implying about where the market will head. I see a lot of investors who are, I see some investors, a small number of investors, who are getting excited about opportunities to invest on a per square foot basis or a per square meter basis in heavily repriced office assets. And they say, this is just so much cheaper than we can supply this space for, and I'm going to enter that market on that basis. Well, implicit in that is an implication that they see a rebound, an improvement, a normalization in the supply and demand balance in the marketplace. And because if assets sell for a lot less than they cost to build, then you don't get any supply, and rents eventually have to grow to justify supply again. The real question, though, is how long that will take. And you have to be very patient in some office markets, such as many of the North American markets, for that to happen. And so the rules of thumb of I'm going to buy below replacement cost sound good, but when you take it apart, you are betting on a market recovery of very uncertain timing. And so I think the pitfalls are around approaching real estate a little too simplistically, and you really should have a kind of comprehensive view on all the assumptions that go into how you're pricing it.